Analysis of the economy and the stock market from the fourth week of January to the first week of February. If you take a look at the number of unemployment benefit claims reported last week, 190,000 were lower than the 210,000 that Wall Street anticipated, proving that the labor market is still strong. The Fed, which monitors prices and labor, may be encouraged by this data because it is the lowest level since September of last year. If the Fed, which is currently chopping away at the economy with austerity measures, notices a tight labor market, it will be forced to keep hiking interest rates. Later disclosures from significant firms, however, were startling. Google announced that it would make significant employment layoffs after Microsoft, Amazon, and Meta. This suggested a company-wide effort to cut costs, and following this disclosure, Google's stock price increased by 5.3%, while shares of Microsoft and Amazon also increased by 3%. In addition, despite dismal results, the broad recovery of large internet companies drove the market's upward trajectory, with Netflix rising 8.4% on a significant rise in subscribers. Additionally, comments made by Fed officials, such as Philadelphia Fed President Patrick Harker and Fed Director Christopher Wheeler, in favor of a 25 basis point FOMC raise in February also helped the market. FedWatch data indicates that the Fed had a 99% chance of raising interest rates by 25 basis points at the FOMC meeting in February, which is exactly what happened. Since then, the market has experienced a series of increases as a result of the news of the Fed's rate hike and the performance of significant technology firms. The FOMC is expected to raise the base rate by 0.25% in February as a result of signs that inflation is slowing down. Reporter Nick Timiraos, who has been dubbed the Fed's unofficial spokesman, recently published an article about a 25 BP increase, supporting the theory that the base rate hike range should be lowered. It is. Big technology and semiconductor stocks have also recently contributed to the market's rise. The news of the Chinese economy's recovery was influenced by the increase of several significant technology stocks, and the news of the Chinese economy's recovery and the semiconductor industry's optimistic view this year also had an impact on the semiconductor stock price boom. Microsoft recently made an earnings announcement. Despite falling short of projections, revenues of Microsoft's primary cloud service, Azure, were higher than anticipated. The guidance was announced lower than the market expectation, which also caused the stock price to decline. Large tech stocks and the market as a whole have both been impacted by this. Along with Microsoft, the performance of the businesses that were announced one after the other did not live up to expectations. Boeing and AT&T, which reported earnings, were included in the overall corporate performance, which displayed a mixed trend. The market's avoidance mood appears to have grown stronger as a result of the company's dim earnings projection. However, the Reserve Bank of Canada made the decision to increase the benchmark interest rate by 25 basis points. The Reserve Bank of Canada, which had been gradually raising the benchmark interest rate, stopped doing so after declaring that inflation has peaked and we will keep the existing benchmark rate if the outlook for the economy is generally positive. As a result, there was a mixed finish to stock prices and anticipation that the Fed would also halt hiking interest rates. The market consensus is that despite the poor 4Q business performance, the economy is doing well. Economic conditions such as employment must remain stable and inflation must decline for there to be a smooth landing. Really, can we anticipate a soft landing? The U.S. Department of Labor's January employment data was the main topic of discussion in yesterday's market. In January, employment in the non-agricultural sector rose by 517,000, well above the market's projection of 180,000. In addition, the unemployment rate decreased to 3.4%, marking the lowest figure since May 1969. Expectations that the Fed would cease raising interest rates were dampened as employment data revealed that it had not eased down. Contrary to the prior month, salary growth declined. I was able to calm the shocked market while I checked. Also disclosed was the service sector PMI for January. It was reported as 55.2, which was higher than the 50.6 market consensus. According to some in the market, full employment plus economic expansion equals soft landing, and this data shows that the service sector has entered an expansion period. I also mentioned that I hoped for it. The market yesterday was impacted by the large tech giants' anticipated 4Q results. Apple had a weak performance, missing its targets for sales and EPS. In terms of sales and EPS, Google also underperformed the market, and while Amazon outperformed the market, losses from its interest in Rivian appeared to have taken a significant toll on the company's net profit, which was shown to be down more than 8%. Although the joy of yesterday seems to have faded, there are still a lot of signs that will be shown by March. Nobody is certain that the Fed will stop raising interest rates or even think about doing so in the second half of the year. According to the results that have been confirmed thus far, the interest rate increase has been completed to a range of 4.5 to 5.0, which was anticipated 2 years ago. However, the current situation, which shows full employment and steady economic growth, is a good place to buy high-quality stocks at a low price. It appears to be a market. Furthermore, I think the last video makes a great point about Tesla and secondary batteries, and I believe it is preferable to see the current market from the opposite perspective rather than from the standpoint of an economic soft landing.